We're wrapping up the Syndication E-Course. This is section 8, Formulating Your Investment Philosophy. Basically, what we're going to be talking about is a bunch of topics that are a little bit more higher level and holistic thinking. In the past weeks, we definitely dug into the numbers in the numbers section. Here, we went through a checklist. We talked about the people and understanding the deal structure. But this section right here is taking everything with a grain of salt, looking at syndication deals, especially for new people. I think now going through this e-course, you probably know more than most accredited investors out there. You may weigh things a lot bigger and you may be aware of things that most sophisticated investors, they're aware of it and they look out for it, but it doesn't really deter them from investing or not. Most people, I would say, that enter a group with $1 or a few $1 million net worth, think about it. If you're able to deploy 20, 30% of your net worth into alternative investments, and then that grows, maybe doubles in 4 to 7 years, and you can redeploy that into 4 to 7 years again, you're going to be set up in a place where you're probably going to be financially free at that point. The other half of that equation is the taxes side. If you're able to use these strategies with or without rep status, a lot of times you can bring your taxes into the 20s at the very least, I think. Some people can drive their taxes down into the teens or into the single digits. But here's the viewpoint of what you may expect in the monthly report, but there's huge ranges in what reporting you get for these types of deals. I would say if you're somebody who really likes to read into the monthly reports, number one, you're not in enough deals. And number two, this may or may not be for you, right? And most of the investors invest in a myriad of deals, or should, and they're diversifying their portfolio into this big scattered plot of deals out there. I put this video in here because, hey, at the end of the day, this is ultimately a game of how much money you can save, then invest in a business. Like in these types of deals, it's income minus expenses. Remember, your business is your personal finances, which is how much money you make at your day job or your business. And then you minus that from your expenses, and that's your net delta. And that's where I've always said in our group, most people are around $50,000 to $100,000 of net savings per year. If you're someone who does the traditional 401k type of stuff, yeah, that you count that because it's basically going to your bottom line, and that's your net delta. Now, if you can imagine, once you're starting to go into at least maybe a dozen deals, and those dozen deals, maybe half of them are starting to cash flow, not even including maybe if one exits early, you could imagine how your net cash flow goes way, way up, maybe $150,000, $250,000 a year. And that's where you hit this hockey stick. If you're a new investor, and that's just kind of theory, right? But I think this is something where a lot of the more experienced investors they actually see this happening. And this is where, unfortunately, you got to put in the dues. It took me, 2009 was when I was making $50,000, $100,000 a year net savings. And I plowed that into investments for pretty much a decade. And then bought those 11 rental properties and then parlayed those rental properties into syndication. So I did it the long, slow way. But I'm a tad younger than our average investor in their late 40s. And with that comes a lot of personal development. That's how we do the New Rich Life podcast, because you basically trying to optimize your finances here with you're taking on risk, but the idea is you're doing everything you can within reason, with a reason about a risk threshold. And you focus on other parts of your life, which is relationships and health and your mindset and trying to be a better person. And here's some types of different happiness archetypes here. I've always said that people always talk about this road to enlightenment. And I think about it as a highway, super highway, where not many people get to, but there's different on-ramps onto this super highway. For me, it was getting to somewhat financial freedom and getting to a point where, I knew I was going to be okay, right? I didn't have to be that cheap guy who just was super tight and just was all about saving money or optimizing my finances. which I get. Like I said, I was there at one time. But you eventually get yourself on the superhighway, you get yourself good, and most people get to a point where they help each other out. People get on the superhighway on different on-ramps and different methods. Some it's physical fitness, some it's just your pure mindset way they get there. I think a lot of people for our group who is very much money focused, I try to get people on that super highway on the on-ramp of financial education. And then you get to a point where you have abundance in your mindset. But anyway, back to investing. We talked a lot about individual deals. What you want to be developing in your head is like a strike zone, if you think about it in terms of baseball. When you talk to other investors, and now all you guys are probably ready, more than ready to make it out to one of our events for a little test drive. When you're interacting with other investors, the discussion can be you're speaking the same language in a bit, and you need to somehow voice and communicate your strike zone. Some people, maybe the risk-taking whiskey drinkers out there, they may like deals that are 30% occupied with drugs and crime because they know that there's a huge amount of value add they can do. I guess specifically saying these are like your apartment complexes that are 30 grand a unit for Class C, where if they bump that up to Class B, maybe they could sell it for 100 grand per unit. Huge upside. But takes a certain type of investor and certainly an operator on that type of deal. This is where you need to develop what you are looking for, and just also know that not all the deals are going to fit perfectly within your strike zone. But in reality, maybe you want to be thinking about it that the weighted average of all the other deals that you're in holistically on your portfolio somewhat fits within your box that you're trying to go for. I wouldn't use this as like a way of like you to do it. This is a way of, at one time when we were really heavily focused in real estate, there are all kinds of investments out there: venture capital, angel investing, private equity, even like different types of things outside of multifamily apartments, self-storage, and if you've heard lately that there's ways that people are like developing basically like Uber, Airbnb of self-storage. So I don't know how that's going to impact the industry. I think it's like neighbor.com. But anyway, you need to fit all your investments on a scale, sliding spectrum. So if this is an example of just multifamily, right? Just to give you an example, I mind mapped it as you got Class C down here, you got Class A here, heavy repositions up here, more yield plays, which is like pretty much no value add here. Not to say that one is better than the other. This is where it's all personal preference. But you're going to start to develop your own investment values, right? Like one of my investment values, if you go and look at the FAQ document in the investment philosophy, I think it's in the last page of that. If you don't have access to that as a new investor, please reach out to the team for that document. It's a pretty beefy document. It's like 10 pages, but it's all the frequently asked questions, which most investors typically ask us. But ultimately, it comes down to like, how do you like even start looking for investments or things to invest in? You need to develop some kind of investment philosophy. So mine's is in there. One of them is like workforce housing, things that are for like the lower middle class, because I believe that the rich are getting richer and the poor are getting poorer. And there's a sort of underserved population out there that, in theory, if you invest in apartments, they should be doing well in recessions. So that's what drives my investments. I like to also invest in things where I like to see a run rate, a profit and loss statement, or something that's already in business. So I'm not exactly too keen on angel investments because they're just ideas at this point. They're not in business. They're not making any income. They just got a lot of expenses. That said, as we start to go down into this risk reward idea here, the more risk you take on, typically your upside return goes way, way up. But at this point in time, my personal investment philosophy is more like a value investor. I'm less keen to invest in angel type of projects. Not to say I won't do one, of course, right? It's got to be the right one. And if you emulate what large family offices do, they'll typically take maybe a small portion of their portfolio, maybe anywhere from like 1% to 20% to give you a big range there. And they'll go after asymmetric plays. Now, you're obviously nowhere near that $50 million net worth mark. But I think it's good to emulate that concept in your own portfolio. If you can't stomach it, maybe these asymmetric types of deals isn't for you. Fine, just stick to the real blue chip type of investments out there. Again, you need to develop your own value system and things that you believe that are going to be around for a long time, 10 years plus, things that you are also against, right? You may believe, I can't think anything off the top of my head, but you may believe that a certain sector may not be around anymore. You may believe that the government's going to start to 3D print small micro units for the underserved parts of our community. I don't think that's going to happen, but heck, you need to come up with your own ideas so you can sleep at night. At the end of the day, you're taking ownership of your own portfolio. Everything that we're sharing here is just infotainment, not to be taken as financial advice, because apparently I'm not a financial advisor because I'm not licensed to sell you commission-laden products as a certified financial planner. But these days, really, at least in our community, nobody really likes those guys anyway. So I think if you think the same way, you're in the right place. I should probably move this risk versus reward section into, or maybe it's in the number section. There's a section in there just in terms of like, when you look at a deal, what's like the lending format? The lower risk types of loans are long-term Fannie Mae, Freddie Mac fixed debt. So these notes are anywhere from 5 years to we've gotten as much as 12 years. I think that's a little overkill, but then you start to go up to these bridge notes that last less than 3 years. So if you're caught in like a cycle, if you bought a property in 2021 and the market corrected 30%, you get caught on those types of deals. But if you're following along on this, like what this chart's trying to say, your return profile that you could possibly get goes way, way up. Now, some investors are like, I never want to be in a position where even if you're doing a really good job on the asset, that the market puts you in a tough position. Therefore, I want to take that out of the equation and only go into deals that are 5 years plus on the note. I'm like, all right, cool. But just know that finding deals where you're going to double your money in 4 to 6 years is going to be really tough. And at the same time, if you're somebody who wants to 20, 30% returns on your money every year and maybe double your money in 2 to 3 years, have that possibility to do that. If the market is going well, then you're going to have to get into these deals that use bridge notes. So not one is better than the other, right? Is diversify your investments. Don't just go into a few deals. You need to be getting into more than a dozen deals. Now, that's going to not be possible in your first couple of years of investing, but certainly bridge your deals over 4 to 7 years, right? This whole concept of dollar cost averaging. Unfortunately, I see this mistake in most cases where people are just dabbling in this type of stuff, right? They're dipping their toe in, and I get it. That's going to be for everybody. But at some point you have to think, what is real? What is like a true business, and which ones have all these middlemen in the middle taking the cut with me taking the risk anyway, which I'm referring to the stock market type of stuff. Maybe you go into one of these non-recourse bridges for every 3 of the Fannie, Freddie boring fixed debt deals. Maybe it's the opposite, but you need to figure out where your risk tolerance is. Businesses are typically a little bit more riskier, although people who own businesses are a different breed than some of the salary guys, right? The salary guys are very stable jobs. In theory, you should be taking more risk. But unfortunately, salary guys are very less keen to risk. But you get what you pay for. In this case, the more risk you take, you get the returns that, based on this theory chart right here, is what you're going to be getting. We talked a lot about like value add, right? When you're doing either physical construction, you're rehabbing units, or value add can even be improving the tenant profile. Maybe it's a industrial property and you or the operator have the ability, because of your Rolodex, to find better tenants that will pay more, that will bump the income and improve your NOI. Another example of value add might be if you're buying online businesses and you run a team of SEO experts and you can do some link building, that's a way of value adding the business. Ultimately, anything that increases the net operating income is considered value add, whether it's physical, virtual, or management play. An operator are typically an optimistic person, and they should be a confident person. They should be confident in their skills, right? And because they've likely done this many times in the past. And there can sometimes develop a cavalier attitude of, hey, if the market corrects 10%, I don't care. I want to be value adding this business to more than account than what a typical market correction can go down. If you're like a really good canoe paddler and you're rowing in the water, but what if there's like a mini storm coming and it's now you have the currents in your face? Depending on how strong the currents are, that paddler can probably still cut through and move forward progress. But this is just outlining here that sometimes, and we call these black swan events, sometimes you have these situations, maybe 1 in 10 years, or maybe even 1 in 40 years, like how we've seen interest rates bump up the highest in 40-year history, the quickest time in history, which makes it the black swan event. You have pandemics, for goodness sake, right? Like things happen on the 5-year, 10-year time horizon. You're pretty assured of seeing something happen. I don't want to go there. Things happen and you see what happens in the short term, the 5, 10-year horizon. And sure, maybe if you're a good value add or if your timing works out, it's not a big deal. But sometimes these corrections happen that are more on a generation timeline. So I'm saying like 10 to 30-year time horizon. Another way of thinking of this is as an engineer, you build bridges to typically 100, 150-year flood standards. These flood standards are basically to withstand a 100-year flood that comes around every 100 years. It's not really practical to build these bridges for a 5,000-year flood. That's just not practical from a cost standpoint. You have to draw the sand in somewhere. Now, this kind of speaks to going back to our previous topic. Might be somebody who's like, oh my goodness, somebody could die if this bridge collapses. You must build this bridge to a 5,000-year threshold. If that's your case, maybe you just need to interact with more investors, but perhaps this types of investing is not for you. Maybe you should just invest in life insurance, go back to the infinite banking e-course and just buy a bunch of life insurance and just get 5% there. That said, if your net worth is under $2 or $3 million, you got to get off the bench and do something too. You can't just invest in life insurance. But I think it's important, like what we've gone through in this e-course is understanding at what point can these deals withstand a X amount of year flood. Maybe it's acceptable that it sounds like there's some buffer in the rents if pro forma isn't hit. At least we'll make a little bit money, right? Yeah, I'm okay investing in a 50-year flood bridge to stick with the metaphor there. Yeah, so capital calls. You have situations where the market goes down 30%. It's going to create these situations where the equity group, which is a passive investor group, is going to be asked for a capital call to keep the deal going. I would say that from a passive investor standpoint, this is the beauty of being a passive investor. Of course, check out your PPM, but in most cases, it's a situation where passive investors, there's not really any punitive repercussions of not adding in more money. That said, if a capital call is really going to mitigate the solution, that could be an excellent opportunity to buy up other common equity shares much, much later into the game. And I think rightfully, but that's another risk, right? I would say that like some investors, I talked to one investor, this is a long time ago, and they were like in 5 deals at 100 grand each, just call that. And they were like, oh, we keep around like $250,000 of liquidity in our infinite banking just in case there's a capital call. Now at 50 cents on the dollar to what they put in. And I thought that was way too overkill. That's like building a 5-year bridge in a way, their mindset. And I told them like, look, check your PPM, right? But most cases, if you don't got the money, you don't got the money. Then they can't take it from you. You get diluted. Your 250,000 that they had would probably be better in other deals than to just be sitting around for the small chance that capital call gets pulled on them. So for larger LP partners, so I probably should update this I actually wrote this into the new book in the Wealth Elevator, which you guys can get on Amazon. But what this is saying is like for larger investors, guys that are bringing maybe half a million, $1 million or greater to a deal, typically you can engage in a conversation with the general partner operator to negotiate. I mean, this is actually what I do for our group when we go into some other operators' deals. Like a lot of these industrial investments, don't quote me on this, but I believe that originally the deal for like people off the street were like a 70-30 split where investors got 70%. And I was able to collate our investors up and get an 80-20 split. So much higher split, probably a plus 30% better splits and a higher preferred rate of return. I think it went up from 8% to 9%. But the splits are the more important part in that one. Why? Because like most good operators don't really want to deal with retail investors. And I'm sorry to, say it's a little bit of a bad word, but if you're an investor who doesn't have $10 million, you're considered a retail investor. And especially if you're a new investor, people ask a lot of questions. They're very skittish with their money, and they're just not kind of a mature, accredited investor. And most operating companies don't really want to deal with that. The ones that you see on social media and are marketing all the time that you guys always bring me their deals and show me, these are typically the good marketers and not necessarily the best operators. And they have really good customer service on the front end. And these are the kind of the people, I don't know, we've moved beyond this class of operators at this point. Like that's just the state of the dynamic of investors to operators. But you could do this on your own, right? If you're a bigger investor and you wanted to negotiate for slightly better terms, if you're bringing in like a $500,000 check, I think you could start to engage in that type of conversation. So now you're educated. I would say most people here, you've gone through all these sections in this e-course. You probably know more than most accredited investors. I'd say have the confidence to mix it up with other people within our family office Ohana Mastermind. That's really why we have it there. We have over 100 people in that group. It's a pretty dynamic group of people come in. They're really engaged in this type of stuff. People get to a point where the passive investors, they expand their learning, they grow their network of maybe they're supposed to go through everybody. But I think what ends up happening, you build a little personal roster of 5 people or maybe a dozen people that you feel like are really good lifelong connections, and you stick with that group because you don't really need more than 20. You don't need 100 people, but you just need a good select amount of people that are aligned to you. I always tell my guys, like, this goes beyond syndication investing and investing in alternative investments. It's always like, well, if you died and your spouse didn't know a thing that you were doing, at least they know some other spouses of these people that you know, and these other people in our mastermind that can help you pick up the pieces. By that time, you'll be dead. So maybe you don't care, but that just a thought there. There are some deals that are more vanilla. There's more chocolate type of deals where it's a little bit more bigger return type of profile. So whenever you look at a deal, of course, that we talked about this in the understanding the deal section 2 and the number section. All right, what am I looking at? What kind of a value add plan is this? So I would say develop your strike zone and know what you're looking to get into from a high level, then start to dig into some of the numbers from there. And I would say that's maybe the better path for people under a couple $1 million net worth. You haven't yet hit that critical mass number of $4 or $5 million. You may have to go after outsized returns, or you may have a skeptic spouse or be extremely skittish and new to investing off Wall Street. And you may want to go into boring cash flow, lower risk, lower return types of deals. Each to their own. One takes a lot longer. One has a little bit more risk, but there's different paths to it. And as I mentioned earlier, there's an infinite amount of paths because it's not just one deal. Remember that. People fixate on like this one deal and they spend like more than several days stewing it over. Just get moving on it and get working on your other 12 to 48 other deals you need to be selecting over the course of 4 to 7 years. Get moving on it. So we should probably put this in like a tax section here. People don't really do 1031 exchanges in this type of world because what we will do is we call it the lazy 1031 exchange, where you're transitioning into syndications and private placements over the long term, and you're using passive losses from these types of investments to offset your investments that you might be selling out of. Now, if you're brand new to real estate or alternative investments, you probably don't have to worry about this stuff anyway, because when you sell portfolio stocks, that's all ordinary income anyway, and you can't really shelter that unless you're doing real estate professional status. But if you have a rental property, like in 2018, I sold 7 of my single family homes and I had $200,000 of capital gains. I just used my $200,000 of passive losses that I had banked up on my 8582 form. Didn't pay taxes that way. If you're somebody who has rental properties, I would highly suggest get a hand on your 8582 form and see how much of these passive losses you have banked up so that you know how much you have to offset when you start to sell off those rental properties and harvest those capital gains and get the depreciation recapture there. The problem with this 1031 exchange is basically you're taking multiple properties and building into bigger ones. And that's one of the big problems I have is you want to be breaking up your portfolio so you're more diversified. Again, 12 to 50 types of investments out there, as opposed to most people who have these 1031s or have been doing 1031 exchanges. They've got all their net worth in one or a few clumps of deals. So common case, they own an apartment building in California that's worth $5 million and their net worth is $6 million. Good job, but you're screwed in terms of diversification there. And being a 1031 seller puts you in a really bad position, and everybody knows to abuse you because you're a forced buyer too, right? Because when you do a 1031 exchange, you only have 45 days to identify another property and then 180 days to execute it. Just don't put yourself in that position. And unless you have a capital gain of more than like $1 million, absolutely not the right tool for the job is the 1031 exchange. If you got a capital gain depreciation recapture of over $1 million, just shoot us an email. We can talk to the situation. And you may be more lined up to a monetized installment sale, or I'm not a huge fan of these DST structures out there, but that might be an option. But the last option is the 1031 exchange, which is funny why it's in the forefront of most people's minds. But a real simple way is, especially if you have, even if you don't have real estate professional status, when you sell your property, it should be considered passive income because it was a long-term investment, and therefore you don't need real estate professional status. In real estate, you sell the property and to recapture those losses. That's a very important key distinction there. Unless you plan to just die with your real estate, that's another way of getting around. You can do what's called a tenant in common structure if you are bringing in maybe $1 million plus of equity into one deal. It's a bit pain in terms of writing in the tenant in common on alongside the syndication group, which may have 50, 100 plus investors. It can be done, but because it's such a kind of a painful thing, that's why most operators won't even want to bother with you unless you have more than like $1 million of equity coming in. Now, I've seen some operators, they kind of use in conjunction with another strategy of using a DST to make this happen, and then they bring in smaller investors. But number one, I don't really think that the DST, I'm not a lawyer, but I think they're a little janky on how they're together. Namely, I think it kind of skirts around the tax laws in a way where it's obvious what you're trying to do. And I don't think that there's too much case law. But the second point of why I don't like it is now you're stuck with that operator forever. And especially in these types of deals, a lot of these deals are less than 5-year, certainly 10-year projects. You're going to be put in the same damn position that you were in the first place. And that's why I think some operators like to promote it, because in a way you're stuck with them, right? You went full cycle on a deal, but now they basically have you tied to them for a long time until you pull out. And then when you pull out, now you have to pay the taxes on it anyway. What you really should have been doing was the lazy 1031 exchange method that I mentioned earlier. I just don't think that it makes too much sense for most people's situations. And again, you want to be diversifying your portfolio into little chunks of ideally less than 5 to 10% of your net worth or less. So a discussion on inflation. Inflation blew up post-pandemic. This is me with my crystal ball. I just feel like inflation is going to come back like a mother in the next year or few years. And if you believe that, then what you want to be doing is buying commodities. Now, commodities can be, if you're a stock guy, like coffee, I think beef, that's a commodity, right? Or wood. Some people will go to buying precious metals. Although I always tell people be careful buying precious metals because it's typically being sold by affiliate marketer who's trying to scare the crap out of you. The world's going to end. I think the best commodity out there is real estate, especially real estate that has utility in terms of you're able to make some rent money along the hold. You can't make cash flow or rents off of bars of gold or gold certificates. That's just not how it works. And in fact, the reason why I like real estate is it is a diversified pool of multiple commodities, right? You got the lumber, you got the steel, you have the utility of housing Americans in it. I don't know what more of a commodity you can get that also produces cash flow that you can take advantage of appreciation, principal pay down, good leverage, and the tax benefits that we mentioned. If you believe inflation is going to be a big thing in the future, then load up on real estate that produces income, just in case it doesn't. Inflation is a sly way of taxing the poor because the wealthy people or sophisticated people like you guys will buy assets that go up with the pace of inflation. Unsophisticated people who don't have money, that aren't attuned to buying assets, their dollar that's there in their pocket before they buy a pack of cigarettes is going to be losing value. So it's this constant divide of the rich and the poor. But if you're seeing the writing on the wall, you need to ask yourself, which side of the line am I going to be on and what am I going to be doing about it? Again, I'm not a person to just doom and gloom and use fear tactics to get people to do things, but you got to understand how money works. And when inflation happens, rent goes up. Unfortunately, when people go to the restaurant, say the price of eggs go up, that's your commodity, eggs in this case. Here we pay, sometimes we're paying like $6, $10 per dozen here in Hawaii. And that ultimately gets passed on to the consumer. Minimum wage. This is a testy topic here. When you increase the minimum wage, all that does is just puts more money in the system, increases inflation, and just makes the cost of living for people who it was meant to help to go up. It is a bit of a chicken and the egg thing and it kind of bounces back and forth. But when you have higher inflation, things like the rent goes up, which impacts the bottom class of Americans. And when inflation goes up, our rents go up. And you want to be in deals where you're assuming rent increases are going to be going up maybe 2 or 3%. But if it goes up 5%, this is when you make a killing on these types of deals because you can show that higher net operating income. And then obviously, as we said earlier, commercial assets are so based off net operating income. I guess in this example, if we assumed a 7% rent growth and a 5% inflation rate, you had $1 million of income and then you had $70,000 of rent growth. And then say your expenses grew, right? Because your expenses are always going to grow because that's also impacting you too. But overall, your net operating grew by $45,000. So if you plug it into the magic formula here, net operating income divided by cap rate, you just increase the value of that property by $10 million just by the market helping you there. So again, have the confidence that you guys know a lot about this stuff and you can speak the lingo, start to develop your strike zone, your investment philosophy, and be able to communicate that so that you can start to concisely communicate it to your growing network of people, which this is now the name of the game, especially as accredited investors. And how specifically do you communicate that? I would say, yeah, most of the deals I like to go into, and I like to go into bridge debt deals where we can get some asymmetric returns. I typically like to hedge my portfolio with my life insurance anyway. So I feel like I'm covered on the backside there. Now, that might be a cool way of explaining essentially your investment philosophy in an elevator pitch right there, just as an example. if you follow my journey, like I started investing in 2009, and then from 2009 to 2015, I went from 0 units to 11 units. A lot of this was I stuck to myself during this entire time. People who know me pretty well know me as a pretty introverted person. I like people. I just don't like in big crowds. Especially don't like it when I have to talk to people about like super basic financial stuff. That kind of annoys me. I like to talk about this stuff a lot more. Like I realized in 2015, number one, I started to interact with accredited investors, started to find a lot of these best practices that we're talking about here and syndication deals. And I started to realize that a lot of accredited investors got out of their little rental properties and went into more of these types of deals. And I'm still learning things today, right? Like I think you'll see that in the Wealth Elevator book as I start to talk about the penthouse level and the higher floors of the Wealth Elevator. What's the mindset, the tax strategies, and some of the investment mindsets that are in those higher floors. And a lot of that I pick up from the peer investors, the operators that I interact with, some of the higher level family office type of investors I'll interact with, and the piece from conversation, some of those ideas, tips, and mindsets. In my growth, like 2016 to 2022, we picked up thousands of units at that time. And you could probably say it was about time to hit that asymmetric part of the hockey stick that we call it. And that'll happen for you guys too. It is slow go in the beginning, but this is not the get rich quick game. You've got to deploy if you're under $2 or $3 million net worth. You got to go. You got to get after it. And you may have to invest more than 20 to 50% of your net worth into alternative investments. If you're over $4 or $5 million, you have the luxury to sit on your butt and do less. I think it's important to understand where you are, what floor of the wealth elevator you are at. And part of that is now you need to surround yourself with other people that are like-minded and also moving on the same trajectory. If you're like me, who didn't grow up with other trust fund kids, likely you're doing a lot better than a lot of your peer group, people you went to college with, people in your coworkers. But don't compare yourself, compare downwards is what I'm saying here. Compare yourself with people who are switched on to these best practices and start to get around other of those people. Most doctors, they make phenomenal salaries. And I'm calling them out because we all know they make phenomenal salaries, but most of them are pretty horrible with personal finance. Their net worth by the time they hit the ages of 50s are barely over $1.5 million. The doctors that do this type of stuff, their net worths are pretty much all over 6 million, hitting 8 figures by the time they're in their 50s if they start earlier. So it's night and day. But yeah, tips for networking. We have a networking guide. If you guys ever come to an event to test drive, we allow people to come once. It's a pretty in-depth guide. Always try to be adding value to people. And it's hard in the beginning when you don't know very much, going and being an ask hole anyway, where you ask a lot of questions. But I think that's what's cool about our group. I set the tone and the culture from our high level folks to always give back, send the wealth elevator back down to new guys because we're all there at one time. But I would say, well, the one big tip I would say is stay away from these are the people looking for the free and easy option. And these guys never get anywhere. This is why the free meetups, local real estate clubs or RIAs, and the uncurated internet forums out there are like the worst places for high net worth investors to build their network. You guys can try them out, but you'll see what I'm saying, right? And there's some like forums out there, but it's just it's all I know what they're saying on those things, and they're always got the reasons wrong. Why? They're just an unsophisticated passive investor making inferences incorrectly. And somebody was like, we had an investor meeting last night and somebody said, wouldn't it be nice if there was a review site for all these private placements? And yeah, there's been a lot of them and they always come and go because it always gets to a point where the people who create the form start to take in sponsorships and you, the user, never see this. This is all behind the scenes. And this is what's messed up, I think, about it. So there's really no way of policing this. And it just goes to trash at some point. And this is why I specifically, when we tried to make the FOOM in our inner circle, I knew that was the typical trajectory of these types of groups. But what keeps the glue, I think, is like the community and those more deeper relationships. And in the early days of the firm, we had a bunch of guys who would just be coming in and who are the people I should invest in, like very transactional people, and wasn't a good culture fit. And we've tried to filter those types of people out of the inner circle because that's just not what in the future is do like a deal desk concept where you guys submit deals and we underwrite them and we go through the due diligence in a little webinar format. We remove the names and all the P&Ls, the rent rolls to protect the innocent, but we want to make it really educational for people. Obviously, there's big liability that we take on that obviously make people like sign off, hey, this is just infotainment. We're not like a building inspector, house inspector, or deal inspector here. But I think by going through deals and picking it apart, it is like the next level of this education. It needs to be done in a smaller group format because that stuff just can't be leaking out all over out there. But it also is my backhanded way of finding more deal flow out there from operators. The best operators are the people who don't do any marketing. They actually don't want any retail investors bringing in $50,000, $100,000 checks. Those are the best ones to find. If you guys know any of them and they're your neighbor, please connect us. I would like to meet those people. I will visit their office, shake their hand, get to know them. There's a bunch of stuff on insurance here. I think we have an updated section of this in our frequently asked question orientation document. If you guys haven't got that, shoot our team an email, team@thewealthelevator.com. But we've reached the hour here. Enjoy the rest of the weekend. We'll see you next time. Bye.